Imagine a hotel on every corner of a booming market, but run like a tech startup. What if one organization turned data, franchising, and smart partnerships into a rocket fuel for growth? Even while travel markets wobble, stay with me. In the next 2 minutes, you'll see how a low-profile hospitality player used modern tech, aggressive franchising, and clever deals to punch above its weight. Trust me, you'll want to know the ticker at the end. In this video, I'll reveal 3 surprising moves that drove expansion, the single technology shift that multiplied margins, and one partnership that changed investor sentiment overnight, plus the exact ADR price you can screenshot after the 1-minute mark. If you care about value plays, travel, or turnaround stories, and don't skip. Here's the structure. First, a fast timeline of how the business scaled its footprint. Second, the tech, AI, and franchising playbook that made growth efficient. Third, the concrete collaborations and corporate actions that pushed the stock. And finally, what to watch next. Scale came from a simple idea. Be everywhere travelers want to be, but with a light asset footprint. Instead of owning most properties, the model focused on franchising and management, letting local entrepreneurs operate under a unified brand and distribution system. This allowed the company to add hundreds of hotels quickly while keeping capital expenditures low. Where the story gets modern is in data. They layered revenue management systems, centralized booking algorithms, and mobile check-in features that cut operational friction. Imagine dynamic pricing driven by machine learning, automated housekeeping schedules, and targeted upsell at checkout. Each small efficiency raises margins across thousands of rooms. That's how a hotel chain converts more guests into higher revenue per available room without building a single new asset. Franchise economics are central. By standardizing processes, training and brand templates, franchisees can launch fast and with predictable costs. The parent company collects fees while the franchisee handles day-to-day operations. When occupancy recovers, this translates to a quick revenue lift for the corporate ledger while lowering balance sheet risk. In recent quarters, the business accelerated openings, adding dozens, even hundreds, of hotels and building a large contracted pipeline. New openings increase fee income and give investors visible growth metrics to latch onto. That visible pipeline and the narrative that the company is winning on franchise expansion can be a key reason investor interest. And the ADR move upward. The market rewards 3 types of visible moves. 1. Demonstrable unit growth. 2. Steadier margins from tech adoption. And 3. Partnership headlines. Each reduces uncertainty. When a company announces strategic cooperation agreements, dividend actions, or adjusted guidance that looks conservative, investors often reprice the ADR based on future potential rather than past. Weakness, not conservative guidance, carefully worded press releases about pipeline and dividends, and filings with U.S. regulators provide the hard evidence. Investors need to trust the narrative. These formal filings and press releases have been used to broadcast expansion metrics, dividend decisions, and strategic collaborations. GreenTree, Hospitality Group Ltd, ADR, $182. 1 minute into this video, the ADR stood at 182, and that figure is the reference point we'll use to judge momentum going forward. At $182 per ADR, the market is pricing in both the company's current footprint and investor expectations about recovery and margin improvement. The price reflects recent earnings cadence, including an adjusted revenue, outlook, and corporate actions that show management is managing cash and growth deliberately. Recent strategic cooperation and investment agreements and partnership announcements have been important. Earlier strategic cooperation agreements with other hotel groups and recent public announcements about investments and pipeline expansion have signaled to investors that the company is strengthening distribution, channels, and brand reach. Those collaborations make future franchise rollouts faster and reduce execution risk, and markets reward that by bid up in ADRs when confidence increases. Formal filings such as Form 20F and quarterly press releases provide transparency. Dividend announcements and operational stats, hotel counts, pipeline figures are the concrete numbers that turn story into valuation. Investors react when these filings show growth in unit openings or disciplined corporate actions. That's why you'll often see the ADR move in response to these releases. Look for three things. 1. Quarterly data on hotel openings and pipeline. 2. Results from AI tech-driven margin improvements, higher RevPAR or lower SG&A per room. And 3. More partnership strategic cooperation headlines. If openings continue and guidance stabilizes, the ADR could trend higher as investor uncertainty falls. Here's the simple takeaway. A lean franchising model, plus modern revenue tech, plus smart partnerships. A scalable, low capex growth engine. At 182 ADR, much of the upside depends on execution of the pipeline and proof that tech is lifting margins. If you want, I can make a short follow-up that timestamps the exact press releases and filings with links so you can track every catalyst.